Okay, let's dive into this. What if your investment portfolio could literally own a piece of the whole world? For a lot of South African investors sitting there looking at their screens, it kind of feels like a fierce rivalry, right? You've got local pride going head-to-head with these absolute global giants.
So, it all boils down to this. Should you invest in South African stocks, US stocks, or maybe a bit of both? It's a massive question. I mean, you've got excellent local companies right in your own backyard offering really solid dividends. But then, you look across the ocean at some of the largest, most innovative businesses on the planet. Honestly, it can be incredibly intimidating trying to figure out where to actually park your hard-earned money.
Well, don't worry, because we're going to break this all down into manageable pieces today. In this explainer, we'll cover comparing the markets, growth versus dividends, currency risk, diversification and ETFs, taxes and costs, and finally, building your portfolio. Let's get to it.
All right, starting off with part 1, comparing the markets. Before we can even think about choosing a winner or decide if we even need to choose at all, we have to understand the two major players on the board. On one hand, we have the JSE. This gives you exposure to massive local heavyweights in mining, banking, and telecommunications. But then, looking at the US, the NYSE and NASDAQ absolutely swing the doors wide open to technology, healthcare, and global consumer goods. And this brilliantly illustrates a key point. When you buy a US stock like Apple, you aren't just investing in the American economy. You're investing in a company whose customers are spread all over the globe.
Moving right along to part 2, growth versus dividends. Now, the biggest assumed difference you always hear about these two markets is that the US is for massive growth, while South Africa is the place for reliable dividend income. Let's actually unpack that. When we talk about US growth, we're talking about absolute titans: Apple, Amazon, Microsoft, Nvidia. The US market has generated just an extraordinary amount of shareholder wealth by nurturing these globally dominant tech companies. I mean, they literally transform entire industries overnight, from how we shop online to AI. For a long-term investor, having a concentration of these massive growth engines in your corner is absolutely crucial.
Yes, but South African stocks offer really attractive local dividend opportunities, especially for income-focused portfolios. The US might have the crazy, headline-grabbing tech growth, for sure, but many established South African companies are known for actually paying out reliable, steady cash dividends to their shareholders. And that's highly appealing if you're trying to build a dependable income stream. Let's run a quick thought experiment here. Take a look at Company A. It pays a massive 7% dividend, but its long-term growth is basically flat. It's barely growing at all. Now, look at Company B. It pays a tiny 1% dividend, but it boasts high earnings growth over many, many years. So, which one is actually the better investment? Well, the trick is you cannot answer that just by looking at the dividend yield. So the crucial point here is something called total return. Total return is your share price growth plus your dividends, the whole shebang. Many of the biggest US growth companies actually prefer to reinvest their cash right back into the business to grow the share price rather than just handing it out. So you have to evaluate the total return of an investment rather than picking a market purely based on who flashes the highest dividend yield.
Okay, let's turn to part 3, currency risk.
Now we reach the big plot twist for any South African investor buying foreign stocks, navigating the exchange rate between the rand and the US dollar. Here's the deal. If the rand weakens against the dollar, the rand value of your US investment increases. Think about that for a second. Even if your US stock doesn't move a single inch in dollar terms, the fact that the local currency dipped means your foreign exposure acts as a massive opportunity, instantly boosting your portfolio's value in rands. But the opposite is equally true. If the rand strengthens against the dollar, the rand value of your US investment is reduced. International investing is definitely not a guaranteed one-way ticket to wealth, because suddenly you're juggling two entirely separate variables: the performance of the actual investment and the exchange rate. Currency movements can absolutely help you, but they can for sure hurt you too.
Which leads us nicely into part 4, diversification and ETFs.
This brings us to what is perhaps the single strongest argument for investing globally: diversification. By holding assets in foreign currencies, you get currency diversification. Listen, if 100% of your wealth is tied to the rand, you are completely at the mercy of its fluctuations. Global investing fundamentally reduces that concentration. Even if you own 10 different stocks on the JSE, all those companies are vulnerable to the exact same local risks: interest rates, electricity supply constraints, consumer spending dips, political developments, and domestic economic growth. If you only invest locally, you're carrying all of this highly specific domestic risk.
So, how do you safely branch out? Well, picking individual global stocks carries high risk and requires constant monitoring. If one single CEO makes a bad call, you feel the impact immediately. But broad ETFs, like one tracking the S&P 500, offer a much lower risk by giving you a basket of literally hundreds of companies. Exchange-traded funds make it incredibly easy to get global exposure across multiple sectors without you having to sit up late reading earnings reports for 100 different international tech companies.
Let's move to and see how this builds in Part 5, taxes and costs.
Now, before you rush to move every cent you own overseas, we need a serious reality check about hidden costs. You simply cannot ignore these. We're talking capital gains tax, dividend taxes, forex conversion costs just to swap your rands into dollars, plus your brokerage and ETF management fees. I know, they might look tiny on day one, maybe just a fraction of a percent, but over a 10 to 30-year investment horizon, they drag on your wealth like an anchor. So the question you must always ask yourself isn't just which investment made the highest return. It's what return did I actually get to keep after all these costs?
And finally, Part 6, building your portfolio.
It's time to pull this all together and bust a very dangerous myth right here. U.S. stocks are not automatically always better than South African stocks. Markets go through cycles, and valuations really do matter. So what should a South African investor actually do? Well, the secret is you don't have to choose just one market. Your unique blend of U.S. and South African exposure depends entirely on your personal allocation factors. Things like your age, your investment horizon, your risk tolerance, your income needs, and your specific financial goals. A well-diversified investor can, and honestly often should, have a healthy exposure to both the local economy and global businesses.
Now, what's really interesting about this next thought is how empowering it is. Don't let your location determine the limits of your investment opportunities. Just because you live in South Africa doesn't mean your portfolio has to be 100% South African. The entire world is literally your investment universe.
Which leaves us with this final critical question for you to chew on as you evaluate your own long-term strategy. Are you investing primarily for income, growth, or a combination of both? Your personal answer to that question is going to define exactly how you blend local dividends with global growth to hit your ultimate financial goals. Thanks so much for joining this explainer, and happy investing.